I mean, that's widespread optimism about this. But a phase one, a small limited trade deal here will not really address some of the glaring big differences that the two sides do have.
Yes, as you mentioned, glaring differences highlighted again by the Vice President's speech a few hours ago. So that means that they'll want to focus on a more transaction-oriented deal. On the one side, the U.S. suspending any tariff increase, and we've already seen the October 15th one suspended, and we could see the December 15th one as well. And on the other side, as you mentioned as well earlier on, the agricultural purchases coming through. So limited to a very transactional agreement.
This is it. I mean, what are they going to do about some of those other points that are made by Mike Pence about intellectual property, disparities in the way that companies can operate and the like?
That'll take much longer to negotiate, and probably both sides have seen that this ratcheting up of tensions, as we've been seeing over the past 18 months or so, has been detrimental to their growth. So in the beginning, it was they could absorb it, that was fine. But in the last few months, when we've seen confidence dip and manufacturing confidence really take a tumble worldwide, it probably doesn't suit either the Chinese or the U.S. to see a further deterioration. In the U.S., it's quite clear. They have an election coming up next year. They don't want to see the economy fall off in a hurry. So now it's time to probably stabilize that trade war ratcheting up.
Rajeev, though, hasn't the damage been done in large part here? The whole uncertainty of things like the trade war, uncertainty around other geopolitical issues, but trade war fundamentally in this part of the world responsible for this big fall-off in growth. How bad are things in China, and how is that spreading in your view? And as you mentioned, the possibility of stabilization in the offing.
The whole trade tensions have clearly impacted growth negatively. One has to remember they've been offset by domestic policies in a number of countries. To start with China, tax cuts, interest rate cuts, reserve requirements cuts, areas to help the financial markets, to help the real economy, have been implemented. And in the U.S., the Fed has cut rates already twice, keeping the signaling that it'll cut rates next week. That's all helpful to stabilize the markets and stabilize the economy in the face of these tensions. So yes, the damage has been done to a certain extent, but is also partially offset by other policies.
Surely we get a chart up actually showing how commodities underperformance against stock is maybe a long-term trend, but one which has definitely been in place so far. With trade numbers out next week, I think out of China, that should be pretty important reading to see if we get any, perhaps again, a stabilization, I suppose is the word again to use here, of the Chinese economy itself, and what sort of level are we going down to with regards to that with growth?
It'll take a while to see actually any numbers showing that stabilization in trade because of the tariffs. There's been front loading of buying. When a company knows that the tariff is going to go up, it's not going to wait and put its order in after the tariff is implemented, but bring some of it forward. So that distorts some of the numbers that we're seeing, making things a bit more complicated. But we do have pretty good measures of sentiment, and we did see the PMIs come out a few hours ago, the advanced PMIs, and they are showing some signs of stabilization. It's too early to be very positive, but at the same time, we haven't yet reached that presidential summit in mid-November where both leaders will really talk about what deal they are ready to agree on.